starting here now is great. So welcome everyone. Welcome to our, I would call this probably my second to third annual market update via Zoom. And I laugh about the only good thing that COVID brought to us is the ability that now we can really use Zoom. It's very effective, and we can have meetings like this. Everybody can stay at home and get good information. So with that, again, I'm Don Clark, managing principal of Personal Financial Group. We've got a great team. Many of you on this call know between Thomas and Mason, but I'm here today also with a gentleman who I have asked to join us. His name's Andrew Beatty. He's out of our home office of LPL. And Andrew, welcome first off.
Thank you, Don.
Glad to have you. And I'm going to start and just have you give us a quick bio. I mean, tell us a little bit about maybe even some of your education. Doesn't have to be long and intense, just something that tells me a little bit about you. And then I'll jump in and we'll kind of move from there.
Yeah, well, I don't know how much time I'm going to spend on my education, since you may have some Kansas Jayhawk fans in the mix there. But
yeah, exactly.
I did go to the University of North Carolina, so a bit of a rivalry there. Strike one for sure. But I've been in the investment industry for a little over 20 years now. Started my career in the institutional investment consulting area, so working with endowments, foundations, doing asset allocation, manager selection, placements, et cetera, with them, and then have moved to the retail side with LPL. And my role at LPL is to build out what we're considering our CIO services group, which is an outsourced chief investment officer service. Don and his team were one of the first to engage with us. So in that effect, I am acting as their chief investment officer and helping them with asset allocation, market discovery commentaries, and all sort of trading recommendations as well. So effectively, I'm just another voice in the room when they're making decisions, and hopefully that will, layer itself onto making better decisions for your portfolios.
Yeah, well, thank you, Andrew, and I appreciate it. And real quick, actually, the business school that you did attend there at NC, it is one of the premier programs in the nation. So I will give that to you, and I'm glad to have you. And Andrew's right. As our consultant, our CIO, Chief Investment Officer, he has really taken our investment committee to the proverbial new level. He's really helped to integrate. And when we're looking at particular categories or funds or ETFs, we give him the information that we're after. And within a day or two, he is providing us with all the research data we need. He can then offer kind of their opinions, their thoughts, but our investment committee then makes those final decisions. So it's a great relationship. It's a great piece to have. I'm very fortunate to have been a part of the pilot program that LPL has invested in our firm. So Andrew, thank you. Let's jump into the meat. How's that?
Absolutely.
Sounds great. So what I want to start with is, each year, everybody comes out with what's your expectations for next year. And that's where I want to start with. What was our expectations last year? What were the things we were talking about? What did I come out and say? And I just want to go through those real quick, kind of the first four. And then Andrew, feel free to interject as it makes sense. But last year we talked about interest rates, and I talked about how the Fed was going to most likely continue to raise rates through most of the year. And then at some point they were going to begin to decline or lower the rates. Well, I missed that barely. The Fed didn't reduce rates. Instead, they came out late in the year and said, we are going to begin to reduce rates. And we did see that, i.e. the markets the last basically 45 days of the year responded extremely well to that call. So while we missed it, and Andrew, in a few minutes, I'll have you talk more about the kind of the expectation of rates here coming up for this year. The second one was inflation. And we talked about, we did expect a decline in inflation. That we did see. It fit pretty much what our plan and what we had expected on that. We'll talk about this year here in just a second. Recession. This was one big key, and one thing that I said, I kind of went rogue on this myself. I had talked about where everybody was calling for a recession in 2023, I had made the comments that I really felt that we were in a recession in 2022. I really felt with as high as inflation was, with where we expected rates, and as well as how people were spending money, I felt like we were in recession sooner than what it was identified as. And I think someday it will come back, usually, 3 to 5 years post, they'll come back and say, yeah, maybe it was a recession. But I want to talk about moving forward and Andrew, kind of your thoughts on what to expect this year. And then lastly, energy and oil prices. We did expect last year for those to decline. A lot of it was supply demand issues. So we'll spend a little bit more time here moving forward. So with that, going into 2024, Andrew, tell me, what do you think? What's your economic expectations? What do you think of the economy this year? We hit market highs at the end of December. What's your thoughts?
Yeah, I think it's interesting to compare what we saw at the end of last year to the previous year, right? At the end of 2022, everyone was pretty upset. Everyone was bearish. LPL, as a research group, we were slightly positive. So we were one of the more bullish firms on the street. Now, the S&P clearly overshot where we even thought it was going to be, but we were directionally correct. And what I'll say is going into this year, it would be easy to be incredibly bullish given what we saw towards the end of last year. But we do see some headwinds on the horizon. We do think that the Fed has, while it may have waited too late to act, has acted responsibly, and we're probably going to see a shallow recession towards the beginning of this year. But we still see earnings growth in equities. We still see opportunities in the market, and we do think towards the second half of the year, we'll probably start to see a rebound because we're still going to see some slight GDP growth. We're still going to see some lessening of, we think, macroeconomic and geopolitical tensions. So we see that as all being a beneficiary or beneficial to the market, but in the second half of the year, once we get through some volatility here at the beginning.
Okay, quick question. Just, how we get in this industry, we get our own jargon and things. One of them, and you see it on, well, I don't care what news, business news you're watching, whether it's CNBC or the likes, they talk about headwinds. How would you define what a headwind is? You hear new terms, and how would you describe that?
Yeah, so one of the great ways to think about that is it's just anything that's going to slow down your progress, right? And tend to think about that in terms of boating. But a good example of that right now is when after the Houthis started attacking ships in the Red Sea, that cut off a lot of the supply chains for various things, one of them being oil and natural gas. That was seen as a potential headwind for commodity prices, but that actually didn't come to pass. We've actually seen prices be resilient and actually drop a little bit. And we can get into that more if you'd like to, but we're looking at those not necessarily existential threats, but idiosyncratic threats that would weigh on performance or weigh on us meeting the expectations that we have for the market.
Okay, that's great. That's as good an explanation as I've heard. And again, so many times we hear these terms, and I think it's good to kind of really discuss them, and they just don't become a word that really nobody knows what that means. And so thank you on that. So shallow recession. When I think recession, I mean, so many times, you attribute recession and downturn in the markets, but that's not always the case. I mean, what's your thoughts on that?
Yeah, I think we could absolutely see a downturn in the market. We've obviously seen a bit of a pullback so far at the beginning of this year, but you're right. They don't always coincide. I think where we see weakness right now is that consumer spending post-pandemic has been incredibly robust, both for goods and for services. And we've seen services spending come back up to effectively being pre-pandemic levels. Goods services are far above where we were pre-pandemic. So what we're looking for is a pullback effectively to where we were pre-pandemic on the same trajectory. And that's really going to lead us to that recession. And it's more of a spending, more of a GDP issue than it is a market issue, although there will be some overlap. And so we do see some weakness for sure in the market.
Yeah, some weakness. And it's interesting you talk about what was the report earlier this week? Spending was higher by what, excuse me, 0.6 versus the 0.4 of expectations. I mean, it was a big jump, and
Right.
I didn't know if that was going to be the case. I mean, because there's still a lack of goods in some areas. So if you didn't shop early or get things done, you maybe were without. But I think what ended up happening, it had to do with those big giant mugs that everybody bought that pushed everything over the over the button. Anyway, that's a whole nother craze. So let's talk about the stock and equity markets. You mentioned a little bit about it, but there's this talk that we did reach market highs. There's no chance we're going to reach market highs again. Any thoughts on that?
Yeah, I mean, look, I think it's really easy to say that what's been happening will continue to happen. That's a behavioral bias we all have, right? It's the hot hand fallacy. If you saw The Big Short, um, and it may or may not be true. I think what we've seen historically, though, is that in years 1 and 2 of a bull market, and we just finished year 1 last year, year 2 has been exceptionally positive. Our average return on year 2 is a little over 12%. So not we're not necessarily expecting, although we do. A lot of the street's not expecting new highs. We do think we're going to see new highs by the end of this year on the S&P, and especially in large cap markets, just because we think the Fed's going to be accommodative. We think even though spending is going to come down, we're going to see more of an earnings rebound towards the second half of this year from companies, and that's really what's going to spur equity markets ahead. It's not necessarily going to be that re-rating of the multiple of the stocks that's going to go up, this more speculative run up, a rally in equities. It's going to be fundamentally driven because there are a lot of companies out there that didn't experience the tailwinds, to use the opposite of headwinds, last year when we saw the Magnificent Seven really take off. There are a lot of companies that did a lot of good things, but didn't get that boost because all the money was flowing into the largest names. Those are especially some of the names that we expect to really rally this year, again, towards the later half of the year. But we'll see that earnings growth there really propel the markets.
Well, let's talk a bit about the large. I mean, so many people are familiar with your large names, your large growth, what we call large value. But as you know, in our portfolios, we're a well-balanced organization when it comes to the equity side of the market. So, I mean, I look at, small values and mid values. It really didn't do so well the last 12, 18 months. But yet we still have a weighting in there. What are your thoughts? I mean, is that going to be a second half of this year? I mean, do we need to reduce down our weightings there? I mean, what are your thoughts on some of that?
Yeah, it's a good question. There's kind of two approaches here. The first one you mentioned is diversification. And I think in any good portfolio, you need to have that diversification because quite frankly, none of us have a crystal ball. We don't know exactly what's going to run and when. So we want to make sure we're exposed across both the style and cap spectrum, including geography if we go to international emerging market equities. But in small and mid cap in particular, it's good to take a step back and look at what happened this past year. And when the Fed raised rates, what that does is it increases borrowing costs for companies that, especially on the smaller cap side, they need to issue debt, they need to issue equity, they need to access the capital markets to fund their growth. When that becomes more expensive, it's more expensive for them to grow, and that's going to weigh on the stock because we're looking at future growth to project out what the intrinsic value of that stock's going to be. So as we move into this year, and I'm sure we're going to touch on the Fed in a little bit, but if we're expecting, and we are, some rate cuts this year, that should lessen the pressure on funding costs for those small and mid cap companies. That should alleviate some of the pressure there. Now, that all being said, we do want to keep an exposure to small and mid cap, but as a firm right now, we're more positive on the large caps. And the reason for that is because of what we talked about from a macro perspective earlier, which is if we go into a recession, however short, however shallow, those larger cap companies, Magnificent Seven, other large cap companies, they have right now immaculate balance sheets, tons of cash, tons of pricing power, tons of, you think about Apple, whenever they release a new product, there's lines around the block at the Apple store, right? That type of consumer engagement isn't really there for a lot of the small and mid cap companies. So those large cap companies will be able to withstand any sort of weakness better than companies on the small and mid cap area.
Yeah, and it's interesting, and we are going to transition now more into the fixed income side, and and kind of expectations of the Fed. But I think we all, I mean, just based off of what the Fed has talked about, we are going to see a reduction in rates. It's just a matter of when. And I think it is extremely important where we've all made money with the large names. We'll continue to do it. I'm still of the mindset I'm going to maintain my levels in those small because as borrowing costs come down, you just have to think like a CEO. Small companies want to get to mid-size, mid-size want to get to large size. And the only way you do it sometimes is the old American way of having to leverage.
That's right.
And leverage means you're going to have to borrow money. And if it gets a bit cheaper for them to do that, then that's when we'll see some of the improvement in those areas. So let's transition to the fixed income. And I don't know, and Thomas, I just thought about it, not that you have to come off. Were there any slides that we should have put on already, or did I already miss those? Or graphs or anything. But if there is, feel free to add that at any time. But let's talk about the fixed income markets. What are your thoughts? What are your thoughts? I think it all starts with fixed income. It starts with the Fed. So let's start with the Fed and then kind of share and walk me through expectations within the fixed income markets.
Yeah, absolutely. I think you nailed it, right? The mantra of the last year and a half has been don't fight the Fed. And I think that's what we're planning to do, is not fight the Fed. They've been very explicit. We're going to be in a higher rate for longer. Higher doesn't necessarily mean as high as we were at the end of last year. So we can still see rate reductions, which would be considered high based on where we have been the previous 3-5 years. But historically, those aren't very high. In the 4 to 5 range, that's not exceptionally high on a historical basis after the 1980s. So what we see happening in fixed income is the Fed will reduce rates. It's a matter of, to your point, when and the magnitude of those reductions. Now, as we see strong data coming out recently, that might push the rate cuts back or make them smaller than we would have expected. But we still do expect rate cuts going forward. So what does that mean to fixed income markets? What it means is that fixed income's back. When we think about fixed income, there's 3 things we really use fixed income for, and that's liquidity, it's diversification, and it's income. And before last year, income really wasn't part of the equation unless you were in high yield. Well, now we've got interest rates at 4+%. We've got bonds yielding 4 or 5%. You can get income out of bonds now. And one of the biggest things about bonds is the current interest rate for bond, or the current yield for bonds, has the biggest correlation to future returns for bonds. So if we're seeing 4-5% yields, we could probably go ahead and pencil in 4 to 5% annualized returns for bonds over the next 5 to 6 years. Now, does that mean they're going to outpace equities? Probably not. But you still need to have those for diversification purposes. And so the next question, of course, is where in fixed income?
Yeah, right. Exactly. And I was going to say, when you were talking, all I kept thinking in my head was more normalized, a normalized bond market, which honestly, it's been a decade since we've seen what I would call normalized bond market. So you're right. So what areas do I go? Do I just put it all in treasuries and hope for the best? I mean, we know treasuries being the safest are going to pay the least amount, or do we go to the high yield, the call it the junk bond sort of market? Do we need to take that level of risk? So what are your thoughts?
Yeah, it's a great question. I think there's multiple ways to address that. The first is, obviously, people ask what backs Bitcoin and things like that, and that's kind of nebulous. But when you think about what backs the U.S. Treasury bills, you look out into the San Diego harbor and you see the Navy and you go, well, that's what backs up the U.S. Treasury, right? So there's clearly safety in treasuries. Now, you are going to run the risk of what we call reinvestment risk. So as bond yields decrease, which we expect when interest rates go down and the Fed cuts rates, you are reinvesting. If you're on the short term of the curve, you're reinvesting at lower rates. So you're getting what we call a negative carry, which is not an ideal situation. And that's just basically if you have a 5% treasury that matures, you roll that into a 4.5, that matures, you roll that into a 4%. You're effectively, dropping your yield every time, which is not a good situation for fixed income investors. All that being said, what we like right now, intermediate part of the curve, so that really 5 to 7 year part of the fixed income maturity curve. We like investment grade because frankly, we're getting great yields out of investment grade. and we're not taking on that additional credit risk that we see in high yield. Right now, we just don't see that we're being compensated for that additional risk. And if you look over the last quarter or so, what you're seeing is the rating agencies are having more downgrades of companies than they are having upgrades, which is not a great sign if you're investing in high yield.
Yeah, that's perfect. So I look back at the decision our investment committee made towards fourth quarter, and we talked about intermediate, and we actually began to overweight and underweight in other areas. So listening to what you and even the support through LPL, sounds like we made the right decision. And as we made those changes, we're set up for this year to really take advantage of what we consider the primary marketplace in the fixed income.
Absolutely. And from a broader perspective at LPL, we tend to think about things as, sourcing assets from either equity into fixed income or fixed income into equities. And right now, we're effectively neutral on equities and fixed income, which is a very big move on the positive way for fixed income. We've been negative fixed income for quite some time. So we like fixed. We think bonds are back, to use a term that most people are using right now. And we just like core and investment grade securities right there. If you need income, if you want to ladder securities and treasuries, that's one way to do it. But we don't think you need to necessarily. You can use other positions and pick up capital appreciation for the bonds and the yield in addition.
Yeah, I definitely agree with you on that. So let's transition. I'm looking at time. We still have about, I'd say, 10 minutes on the high side, just to keep everybody on pace with us. But everybody's talking about, we've got a lot of things going on this year. Okay. And I think of it from a geopolitical point of view. A lot of things going on across the world. There's a lot going on in the US. I mean, from an election year to other things. So talk to me about, is there a correlation between the things that are happening throughout this world? I mean, how's that going to affect our stock market? Do we consider international stocks now, or do we stay, a little bit light on international? So let's talk about geopolitical.
Yeah, for sure. So let's start international markets, as you just mentioned. I think the first thing to remember, a lot of people are wondering, is the dollar going to be the reserve currency as we continue? And look, I'm not going to be the one to stand up here and say that the U.S. has the greatest market in the world, but we may be the prettiest house on an ugly block right now. So, as we look around the world, we see, the Israel-Hamas war right now, difficulties in the Red Sea. Clearly, China, there's always issues with trade and domestic policy there with Taiwan. There are tons of issues that are going on in the world right now. So we still believe that the U.S. is the best place to invest right now. Now, again, going back to your point earlier, doesn't mean you ignore international markets. You still want to keep that diversification. We're just going to toggle it down a little bit and have a bit more weight going to the U.S.
Perfect. And that's exactly what we have done. With our portfolios, we've maintained it. I mean, there's been years, I know I've had weighting north of 10 to 15% in international, and I don't think we're anywhere near even 7 to 10 right now. So
right.
It's one of those continuation. Now, look, as we're looking at it, this being an election year, so many times I've heard through the years in my 30 plus years in the industry, I've heard people talk about, well, it's an election year, it's going to be a down year in the markets. What are your thoughts on that? I mean, I don't know that I always agree with that, but give me your thoughts.
Yeah, we don't really see any correlation there between an election year and market performance, or in the party that wins and market performance. I think that's a thought a lot of people have, and we don't really put a lot of stock in it. Yeah, maybe some sectors will outperform others given a certain person or certain party in the White House or holding both houses of Congress, et cetera. But, look, we are not really trying to take a tactical view on the outcome of an election because we know how that can go if you go that way. The one thing I will say is there's a common misconception that the Fed is reluctant to make changes to interest rates during an election year because they don't want to be seen as weighing on one side of the scale or the other. And if you go back through history and we really look at kind of the post 1980s Fed as the modern Fed with its 2% inflation target, in every single election year, with the exception of 2012, they've made interest rate changes. So the Fed's not afraid of making changes during a presidential election year. So that's something that we've just got to kind of remove from the general consciousness of investors. There are going to be rate changes this year. We know there are. The Fed has indicated, Powell has indicated that there will be. However much John Williams of the New York Fed tries to step that back, there's going to be changes. We think they're going to be down. There are going to be rate reductions, and so we think it's still going to be a good market overall.
I would tend to agree. And I think you're going to see the first, whether it will come in the first quarter or not, I think that's still yet to be seen based on more earnings and a few more reports to come out. But definitely, in my opinion, by early second quarter, we'll see some of the pullback in the market or in the interest rate environment. And I think it has to.
Yeah,
just personally.
Yeah, we're absolutely on the same page there from LPL research with what you're thinking.
Yeah, I mean, if you look at it, I mean, it's difficult for, I look at the, between, to pick on Thomas and Mason as they look to go out and want to buy a house when you've got, mortgage rates north of 7%, housing prices still fairly high because of lack of supply. It almost stymies the market. I mean, there's not a lot they can do. People aren't willing to turn over a house. I mean, I was visiting with a client the other day, and they would love to downsize, but there's nothing to downsize to. I mean, it's going to cost them the same monies to downsize. Well, the situation of the house you have now. It's kind of like we mentioned earlier. The problem you have now, so why convert it to something else you don't know?
That's right.
So I think the Fed's going to have to make a movement. I think they're going to have to free up some monies to allow more building and more expansion, not necessarily just in the multifamily housing, which is where we've seen the biggest growth markets. And it's one that I personally have tried to avoid for my clients. I've seen that really implode through the years, in my many years. And it's one that I've chosen to stay away from as an investing side. So,
and to that point, it's very difficult in that market because the ebbs and flows of real estate is very localized. And so unless you have a specific insight into a local market, it's really difficult to make broad-based bets on real estate.
Yep, I would agree. And there's still been some issues with some of the more retail places. They talk about people working from home. I mean, as I'm sitting here working, from a place in Arizona, I mean, yes, we can do that a little bit more. And I think that's a market that's going to have to figure themselves out when it comes to the larger retail spaces and how that's going to shape kind of the modern business approach moving forward. But I think at the end of the day, most people they want to be in a working environment. They want to work around other people. They don't want to just be in their house 24/7. Right. So I think you'll see that coming back at some point personally. So lastly, and again, people feel free to if you want to get into Slido, if you don't have that and you want to shoot an email over to Thomas or Mason, feel free to do so. I'm going to take a question that I had from a client earlier today that there was a great article in the Wall Street Journal, and the Wall Street this morning talked about there's this 8.8, I think it was an 8.8 trillion cash pile sitting there in fixed income. And there's a lot of ways you can look at it. Is this good? Is this a bad indicator? What does this mean? And I think the story does illustrate few points of it. Me, when I read it as an optimist, I see that as a good thing. I see it as, hey, we've got money sitting on the sidelines. That's money that's going to come into the market. Well, the other side to it is, well, maybe not. People can get actually 4%, 5% money. What's your thoughts, Andrew? I mean, when you read that article?
Yeah, I think it's a little bit of both, right? You're trying to discern what the wisdom of the crowd is at that point. So, I think you're exactly right. For a long time, money market accounts paid nothing. Now they're actually paying something. So it becomes a viable alternative for people who really want to take a lot of risk off the table. That's why they've run so much. But again, those rates are probably going to come down with the Fed. So, are they going to continue to be as viable? It's unlikely. So if that cash is going to be deployed, it's going to be deployed somewhere. Even if it's deployed across equity and fixed income, that should benefit both markets. So we actually see it as a positive thing. As more investors become more comfortable and get a little bit more confident and frankly are forced out based on lower yielding products in the money market space, we think they will come back to the capital markets.
Yeah, I tend to think so as well. And so many times it's hard when you could put in a money market. I see money market rates. I get things all the time at 4.4%, 4.5. You could put it in a money market. And you think, well, I'm going to put it there. That's great. Well, let's say on the equity side, for those who were sitting there in October, November, December, yeah, they're happy. I'm happy with that 4.4, but you potentially lost out on an 8 to 12% run up in the markets. And it's that market timing piece that unfortunately, even as long as I've been in the industry, I don't have that crystal ball to be able to know, when's that market going to turn or not turn. So I still think in today's time, there's nothing wrong with dollar cost averaging into the markets. Even if the markets are high, you still, let's average that out. And I think if we start to see the Fed reducing the rates and the market starting to take off, you're going to see some different highs and lows in there. But I do
Absolutely.
tend to think, yeah, I think it's a personally good thing. I don't think it was this mass exodus. And I think there's been years past where there's all of a sudden this sudden flow of money into cash. We're not necessarily seeing it that way. It was just more of an accumulation of cash, is how I envisioned and saw that.
Yeah, exactly right. It was a linear growth, not an exponential growth. And I think that that's what we're going to see as that cash comes back into the market. There's clearly going to be some volatility to it, but it's going to be a linear, more of a gradual approach back into the market. Nobody's going in the deep end. They're going to wade in.
Sounds great. So I'm going to open it up to a few questions. And Thomas, feel free to jump on in at any point if you want to. You've been kind of looking at some of the Slido and some of the questions that are in there. So if you want to throw any of them out, feel free. I'm happy to start on a couple of them here. And feel free if anybody want to jump off at any time. Feel free. Again, this is definitely being recorded. It will be up on our website here real soon. And you'll be able to watch, the end of it if you'd like, but feel free, to ask away. So Thomas, I don't see your picture anymore. So I just see your picture, not your video. But feel free to ask away, Thomas.
Yep. I'm going to stay nice and hidden so we can focus on you guys here, but I'm unmuted. So we've got 2 to 3 questions here, and it looks like we had 2 others that you guys already definitely answered. First question for you guys is, and I know you guys talked a little bit about this on the home front, but do you guys have any thoughts on taking out a loan now for a car or a house? Do you think it would be more beneficial to wait until the second half of the year or go ahead and pull the trigger? So I know we were kind of talking about that, but if you guys could maybe dive a little bit more into the timing aspect that you guys think on that question, I'm sure that'd be helpful.
Sounds great. Andrew, go ahead. You jump first.
Yeah, I think, look, buying a house or car is a big investment for anyone. A lot of times a house is going to be your biggest asset, that you ever buy. So I think there's a lot of thought that goes into that. In terms of timing, if you have the option to time, as we see the Fed cutting rates, that should help mortgage rates. The other thing is, as mortgage rates come down, that will probably propel some of the folks who locked in a 3% mortgage a few years ago, maybe back into the market. To Don's point, those folks that wanted to downsize might put their house on the market. So there might be a bit more inventory. We're also seeing a lot of housing starts. So the supply should come up. If there is an opportunity, I would suggest to wait. But some people don't have that luxury. On the car front, very similar. We are seeing some cars coming back into stock. We're seeing dealers give preferable financing out there. It's very car and dealership dependent. So, again, if you have the option, I'm waiting right now. I desperately need a new car, but it's going to have to be put on hold for a little bit. I'm going to try to time that market just a little bit.
Yeah, and it's interesting. I have started to see a few of the dealerships. I follow obviously in the newspapers, the rates, and you're starting to see those 2.9% on certain vehicles, not all, but on certain vehicles. That's usually, in my opinion, a leading indicator where we're going. Like you said, supplies are going up and things like that. There was an interesting article I read in Wall Street late year, and it was talking about how a lot of people have gone away from the idea and this notion that home ownership isn't even worth it. The idea that maybe we should just continue to rent and lease long term. We don't need it. and I always hesitate because I think, what's built this country, the American dream. One of the American dreams is home ownership and the ability to have a place as your own. And you can still make money over time. Yeah, we're not increasing. It's not everything's in Florida or Arizona to where everything's appreciating at 8 to 10% per year. But still, you're seeing increases through the years. So I still personally believe that home ownership is one of those things. And if you found, that perfect spot right now, what I'm sharing with people is don't be afraid to use a variable rate right now, because I think you can use a variable rate. I mean, we got away from the adjustable rate mortgages or the ARMs. We got away from those when you could lock in at 3.2. There's no reason to lock in an ARM. But I mean, what's your thoughts? If somebody was ready to buy today, I mean, do you run afraid of a variable rate, or do you consider it at this point?
I think it's really an investor by investor decision, right? Some people can afford to take that risk. Others want the stability of locking in a fixed rate. I completely understand both. And I think that one thing about fixed rate mortgages for sure is that they can be refinanced. A lot of people in the previous 3 or 4 years when rates got really, really low, they had 5-6% mortgages. They refinanced those down to 3.5%. So that's always an option there. But I think in reality, it's probably more a decision between, Don, someone like you and your clients.
Yeah, and I think that's a great point. And you're right. A lot of it has to do with what is, are you in your retirement years, or are you somebody who's, younger, looking for either a new place, or you're transitioning to a larger place or something. I think every situation. So that's the value of a good advisor, in my opinion. I mean, we have a lot of certified financial planners who are part of Personal Financial Group. I think that's a good time because it's not a one size fits all. It's that architecture of your plan, that openness to be able to help you develop what's right for your situation. And what's right for you, Andrew, might not be right for Thomas or for Mason or someone else. It's going to be different for each with that. So as we start to sum up, I think I've tried to implement some of the questions that I've seen, as we've been talking, and kind of interject those as we can. But in the last few minutes, it looks like you're losing lights there.
Not moving around enough.
Yeah. Yeah. You stand up, do a jump, or do everything. And I won't call you out on, who I think you're going to, think's going to win the playoffs or anything this week. And I won't put you on the spot that way. Because I'm a hometown guy, and there's only one team, in my opinion, that's going to win. But I'll just leave it at that for us football fans. But in a nutshell, if you could summarize this year, and you could say, Don, take a note of this. Next year, when we, have this type of meeting, and I'm looking back, what are the 2-3 bullet points you say, Don? These are my main points. This is what I want this year to be remembered as. What are those?
Yeah, I think the first one is bonds are back. Frankly, that is one of the key things. We like fixed income. We think fixed income has room to run, and it's an attractive place right now where you don't have to take a lot of risk to get a solid return. The second is you really need to expect some volatility this year. We're going to see volatility. Don't be afraid of it. We still see overall a positive year throughout 2024. So those are the two biggest things. Otherwise, I think the biggest thing is to rely upon folks like Don and people on your team who understand the individual investors' time horizon, risk tolerances, and their needs and objectives. I think that's the biggest thing that we always say. We can make judgments and we can make projections about the markets, but it's you guys that actually implement it and help your investors get to the point that they need to get to.
Yep, I think that's great. I think with the volatility, the one third part I would add to it is almost like a repeat from last year, that as we are looking at last year, a little bit of more volatility in the first half, even through the summer, but a great end of the year. And I want to tie it into the election just a little bit. And it's a question that was posed to me even earlier today, talking about what happens if we keep the current administration, but yet maybe the House turns over, the whole Congress is completely inverted, or What if it goes the other direction and we see it? And as an advisor, I tend to try to ride right in the middle from the idea of, I just want to be able to react and act, use smart judgment moving forward so that we can make those decisions, because we all know certain political parties are going to have certain stocks that are going to do better than others. And I think as we get into late year and we start to see whether there is, polls or something saying it's going to be one thing, I think the markets are going to react. But I'm just curious, Andrew, do you think do we go ahead and begin to maybe target third or fourth quarter of pulling out of the market? Do you think we just adapt and adjust? What's your final thoughts on that?
Yeah, I think you adapt and adjust. I think that's the constant way to look at the markets. To your point earlier, dollar cost averaging is always the way that we would recommend going about it. But there are going to be some opportunities to take advantage of changing market dynamics. And so when we are updating our internal research at LPL, you guys are the first ones that we call. And so this relationship that we've built, that's how we're looking at the markets, both from a tactical and a strategic point of view. And we are hopefully helping you guys implement that. But in reality, what we see is a volatile start to the year, a bettering second half of the year, and ending up with a net positive. So, like I said, we're not afraid of the volatility, and we think that it could pose some opportunities to invest at really good and nice prices.
Yeah, that's very well said. Andrew, I want to say thank you. I know how difficult your day is in there at the home office. And as you said, you got to go a day without having to communicate with a lot of attorneys today. So it was a relatively good day for you, and I'm happy. But I appreciate this because I think this really, it gives not only kind of a good idea of what we feel and what we think is going to happen throughout the year. I think it really reinforces the research and what our investment team does, behind the scenes. And as we are doing our regular meetings, the meetings that you're a part of as well, I think it really shows the work that we're doing behind the scenes to try to stay ahead and not make it. My big thing is, if I've learned anything, it's to try to be less reactionary and really use sound judgments, to where we're making those decisions, ahead of time in there. So thank you, Andrew. I appreciate it. You're a great person, even though your upbringing. But again, I won't hold that against you. No, I just want to say thank you.
I appreciate it, Don. Always great working with you and your team. I wish I could have a dog in the fight for the NFL playoffs, but as a Carolina Panthers fan, I don't think I'm going to have that opportunity for quite some time. So
I didn't want to go there for you, but I do know that. But hey, it's okay. It's been a fun football season, and I hope it continues for me for another few weeks and to most of the people on this call. So thank you, Andrew. Thomas, thank you to you and Mason and to the team for putting this together. Thomas, feel free to go ahead and close this down at any point, stop the recording, and do what is necessary.